Today, we will talk about free cash flow yield, a critical financial metric. Free cash flow yield is a financial solvency ratio that compares the free cash flow per share a company is expected to earn against its market value per share. The ratio is calculated by taking the free cash flow per share divided by the current share price. Free cash flow yield is similar in nature to the earnings yield metric, which is usually meant to measure GAAP earnings per share divided by share price. The formula for free cash flow yield is, free cash flow yield equals free cash flow per share / market price per share. It's a simple and straightforward calculation that helps investors understand the relationship between the company's free cash flow and its market value. The free cash flow yield tells investors how attractive a company is as an investment. A high free cash flow yield result means a company is generating enough cash to easily satisfy its debt and other obligations, including dividend payouts. On the other hand, a low ratio means investors are putting money into the company but not receiving a very good return in exchange. Free cash flow yield also serves as a valuation metric over an earnings yield, providing a more accurate representation of the returns shareholders receive from owning a business. Free cash flow, derived from operating cash flow, gives a better indication of a company's longer-term valuation compared to accounting-based earnings reporting. While earnings in principle summarize a company's total net income on account, cash flow concerns a company's ability to sustain its ongoing operations. The ability to yield cash flow can be a better indication of a company's longer-term valuation. Investors may evaluate a company's worth by comparing its cash flows with its equity value. Cash flow yield directly shows the cash returned as a percentage of the investment, while a valuation multiple calculated as its equity's market price over the amount of cash flow may not be as intuitive. Evaluating an investment using cash flow yield can be more intuitive as it directly demonstrates the cash returned as a percentage of the investment. Here are 3 key takeaways. 1. A higher free cash flow yield is ideal because it means a company has enough cash flow to satisfy all of its obligations. 2. If the free cash flow yield is low, it means investors aren't receiving a very good return on the money they're investing in the company. 3. The free cash flow yield gives investors an idea of how financially capable a company is at having quick access to cash in case of unexpected debts or other obligations, or how much cash would be available if the company had to be liquidated. Hope this would help. Thanks for watching.